Welcome to the Structural Engineering Podcast. This week, we sit down with Ryan Sullivan, a professional engineer turned financial planner. We discuss ways to set yourself up for financial success and how to approach personal finances as an engineer.
I want to add here, this is something that applies to all of us. Managing pay, benefits, saving. And when we learned Ryan existed, an engineer turned financial planner, we knew he was the guy we wanted to learn from.
One part that really stood out to Max and I was the discussion on health insurance policies and types of investments to be aware of. Now listen along and let us know if you have any questions. Now let's meet Ryan.
I grew up in Portland, Oregon. I came out to Bozeman, Montana for college, and I wanted to ski. And so a lot of snow out here, and so that was exciting. But graduated with a mechanical engineering degree and went to work in Billings and started off in the kind of HVAC plumbing design world. And so working as a mechanical engineer, designing heating, cooling, plumbing systems for buildings across the country. And that was good for a little bit. And but I kind of quickly realized, I sat around a bunch of other engineers and, my boss was right there and his boss was right there. And it's like, hey, I don't know if I want to do this forever. Like, I don't necessarily want to be doing the same thing for, 40 years. And so I just started to kind of, question that a little bit and look around for what else was out there. And so I'd always been kind of interested in investing in markets. And in high school, we did that, the stock market game. And so you get some fake money and pick some stocks. And it was like, I don't even know what I'm doing, but did I win or did I lose? Right. And so I was kind of drawn to that. And so I started doing a bunch of research into that, got really close to like trading. And then I was like, you know what? I'm not sure that that's smart. Like, it's pretty difficult. Most people don't really make money doing that. I don't have a lot of money yet. Let's maybe just hold off. So then I started exploring business and, spent a lot of time, learning and personal development and learning about entrepreneurship and different types of businesses. And ultimately looked at starting a couple of things, wanted to be a business consultant. And then none of that kind of quite worked out. And so I started looking at buying a business and doing that. And again, at one point I was looking at when I actually, right around the time I started hanging out with my wife, before we were married, obviously. And I was looking at buying like a $6 million lumber mill or something. It was like, I don't know, $6 million, and I didn't know nothing about lumber, but that was like just where I was at. I was like trying to figure out, what to do and how to use my skills and what I thought I could be successful at. And so that kind of all came to fruition. And then ultimately I found an opportunity to start an engineering department. And so I went to a local contractor, mechanical plumbing contractor, and basically started an engineering department from scratch. And so that was a pretty cool opportunity because I got to kind of scratch my itch of entrepreneurship and the business side of things without really much of the risk. Like, I got a steady paycheck. I didn't have to worry about payroll, and I had kind of access to the resources of this larger company, but I got to do everything, and it was kind of all up to me and I had very little oversight. And so I just was able to kind of figure it out and make things work. And so ultimately built that up to a good sized team, and learned a ton from that experience, but then kind of still was like, hey, I really like, investments. I like markets. I like finance. I'm doing all this stuff in my free time, and realized, as I started talking to people, like, oh, I guess this isn't normal. I guess most people don't spend all weekend, building spreadsheets to track their finances, or researching different investments and stuff like that. And so I started just having more conversations along those lines and was, seeing where other people were coming from and kind of their level of knowledge, and was like, oh, I guess I have kind of an expertise here. I can help these people. And so started doing a little bit of that. And then along the way, somewhere in there, I actually had an interaction with this guy at a sporting goods store who used to be an engineer, licensed engineer, and became a financial advisor. And so we had been meeting, once a month, every other month for lunch for about 2 years, just kind of touching base and having a great conversation. And I had learned, kind of more about the business model, kind of saw what was possible, saw kind of his lifestyle. And I was like, you know what, I think this makes a lot of sense. And so ultimately dug really deep into that and was like, I'm gonna launch my own financial advisory, financial planning business. And so that's what I did. So I did that. And basically, because of my background as an engineer and just kind of my network connections, the relationships I have there, wanted to, focus in on working with engineers and also architects. And so it's funny, having spent some time in the financial advisory world now, a lot of advisors don't like working with engineers because they're very detail oriented. They ask a lot of hard questions. They're difficult clients to work with. And so I was like, great. Like, I love those people. Like, those are my people. I'm the same way. And so, so that's kind of where my firm, Off the Beaten Path Financial, was born.
Oh, that's awesome.
That is so cool. Did you do anything to sort of soften the transition? Like wait till you had a pool of clients before quitting the engineering job? Or was it you were committed, you really wanted to do it, and you just kind of dove in?
Yeah, so I still do some engineering work as well, and so
Really?
I spent a lot of time thinking about that and went back and forth and had a lot of conversations about it with different people. And I think having a really solid kind of career and position, income, in the engineering world didn't make a ton of sense to necessarily just completely give that up. And starting a business is difficult in any industry, but in the financial advisory, financial planning world, even more so. Usually the first couple of years are just really difficult to get much kind of revenue going. And so I wanted to get to a point where I had, a solid client base, some good kind of growth going, some good income, and then kind of, gradually kind of make that transition.
I also wanted to add to, before you even answered that, I was going to say, I'm really proud that you left mechanical engineering, because all you do to structural engineers that Max and I are is put holes in everything. So I was like, man, thank you. And now hearing you're still doing it, it's like, come on, stop putting holes in our beams and our shear walls.
One less person to worry about, huh?
That's what I thought. We're picking you guys off, but
yeah, I'm always surprised about how willing you guys are to put holes in things.
We just get beat down so often. So we're just like, okay.
Yeah, we're just used to it. Like, yeah, sure.
Whatever.
I guess you just probably start with, much bigger beams and stuff so you can put the holes in.
That's the secret. No, don't tell anyone that. Yeah.
That's the secret.
There's the jab. Okay, so kind of, a lot of what we want to kind of format with this podcast is new engineers, or really anyone young listening to this. And one question that I often get, like right when someone comes out of school and joins the firm I work for, is like, what should they do with their money and how does all that work? So I want to start off with like, what's the biggest mistakes people make in really in general and right out of college with their first job or money management in general, let's say? What are you seeing?
Yeah. So I think the biggest thing I would say is people just start to get behind. And so, things happen and you don't necessarily have all the skills or the knowledge. And then at some point you do things and then you end up in a situation. But I think that ultimately coming out of college is a great kind of starting point. And it's like anything you can do to just make that your baseline and just not go backwards. Right. And so I think for me, one of the things that I really tried to do in kind of my journey was, I call it like leveling up, and so once I hit some kind of threshold or baseline, I never wanted to go below that. And so whether that was an income, whether that was debt, whether that was the amount that I was saving. And so I sort of just made it a priority to stick to kind of the criteria or the threshold that I was at. And then anytime something would happen, I would try to move up, and so over time, like that actually adds up a lot. And so I think, the biggest thing I would say is, hey, wherever you're at today, make that like the minimum, and then what do we need to do to kind of get to the next level? And then now that's the minimum. And then you just keep kind of moving up from there.
I really like that logic. I think that's a great way to look at this.
Yeah. And I've done some calculations on it too. And I made a little spreadsheet, obviously. And about, if I call this concept like triple compounding. And so people talk about, compounding or compound interest, like with investments or, things like that. But if you think about compounding, not just your investments, but your income, and then also the rate that you're saving at, that's a lot. And so I ran some couple scenarios, but I think if I recall, in a 20-year time frame, if you start off making $65,000 a year, which, you can make that coming out of college or with a little bit of work. So $0 save, $65,000 in income. And if you increase your income by 8% a year, which is more than you're going to get by just kind of hanging out, but you can do that. And especially if you, maybe not every year it's 8%, but it averages out to 8%. And then you increase your savings rate by 1% a year, and you start off by saving 10%. It takes you about 20 years to ultimately grow to $1 million. So you could become a millionaire in 20 years, starting off with $65,000 in income and $0 saved. And that's very attainable for pretty much anybody, I would say. And so again, it's just a matter of trying and kind of putting in the effort.
Yeah, that makes a lot of sense. I think, patience is something that all of us need to learn. And, you said 20 years, you can be a millionaire. And it's like, well, yeah, that makes logical sense in a spreadsheet. But man, 20 years, I don't want to wait. But I think that's it's probably, I would imagine, something you tell your clients often is like, just be patient, set it in, put the money away every month. And you'll get there. You'll be in the right place.
Mm-hmm. Yeah. And again, the other way I kind of look at these things too is, like, I always wanted my finances to run in the background, right? And when I work with clients, I talk about, building an automated cash flow system. And so the goal isn't to necessarily have to spend all this time figuring things out or doing this or doing that. It's you put a system in place, you build a system, and it just kind of runs. And so time goes by, and as you get older and older, time goes faster and faster. And, you can, again, these things are like, I always look at it as the minimum. It's like, okay, you're saving this much today. Like, that's the minimum, right? And so you're going to be a millionaire in 20 years. That's the minimum. But what if you do this? What if you do that? And you make it go faster and faster. And so now you kind of have the base plan, and from there, you can do anything after that.
Yeah. You just keep adding on. So let's say I'm graduating college. I'm right out of school. I've got a job. What can I do to set myself up for success otherwise than that, with starting my life?
Yeah. So I would go back to kind of setting up what I call a cash flow system. And so again, it goes back to apparently the minimum, So the way that I look at that is, you have all these things that are going on in your life. You got bills, maybe you got some debt, or maybe trying to save a little bit. You're trying to invest for retirement. But what are kind of like the minimums that you need to do? And so if you got rent or a mortgage, you probably need to pay that. You need to pay for power. You probably need internet. You need to pay for your phone. You got all of these kind of what I call fixed expenses. And so that is the first number you need to figure out. You figure out that, and now it's like, okay, I have to pay these. Then you've got what I call, variable expenses. And that's all the miscellaneous spending. That's going to the store, going out to eat, buying gas, take a trip, you go shopping, buy some whatever. And that number, is flexible. Like, it's not consistent, it changes, and you have control over that. Then the other piece of the puzzle is you've got, kind of short-term, maybe midterm sort of savings. And then I call it like long-term, more investing stuff, maybe for retirement or bigger, longer-term goals. And so I like to really assess people's kind of goals and what's important to them. And so coming out of school, starting off, it's like, okay, maybe you want to buy a house, and so that's like kind of at the forefront of your objective. So, okay, what does that look like? So you kind of figure out how much money you need. You need $10,000, $20,000 down or something. So you set that goal. What's the timeline? I don't know, 2 years or something to maybe get to that point. So how much do you need to save per month? Okay, now that's your minimum. So you start plugging these things in, and obviously I got a whole spreadsheet built for this, but starting off with, like those fixed expenses, how much minimum do I need to be saving for this stuff? Throwing in a little bit for kind of, retirement of these things. What are those variable expenses? And you just group these things in these different buckets. And then you can play around with the numbers. And I like to say, you can have everything you want. You just can't have it all at once. And so I think that's where it really comes down to kind of prioritizing that. And I think where people go wrong, especially coming out of school, they didn't make any money in college. All of a sudden they've got a job and they're like, wow, I can do so much stuff, is they just start spending it all over the place. And they're not very strategic about it. And so I think the point of all of this is to not necessarily like limit yourself where your life sucks and you hate everything and you can't do anything, but to make sure that when you're spending money, it's going to places that you actually care about and are important to you. Because I think it's too easy to just kind of get caught up in the day-to-day and everything that's like, you just burn right through your paycheck and all of a sudden it's like, oh, I guess it's gone. And if you have a little bit more of a plan and strategy around it, you can make sure that you actually have the money for the things that you really care about versus just kind of letting your money just fall out of place.
Yeah, makes me think of like, keeping up with the Joneses, right? You're just spending money because everyone else is spending money and it's just not putting you in the right place.
The big thing too is like coming out of school, especially, you have an advantage. For most people, usually they're used to not having a lot of money, living on ramen and stuff like that. And so, to start there, what happens to people is, lifestyle creep and they just max out their lifestyle relative to their income. But like use that to your advantage when you're starting off, where your baseline is much lower than probably now your income. So you don't have to go all the way, just like make your life a little bit better. And then I kind of see it as a, kind of a carrot out front of like, oh, I need to increase my income to be able to do this other stuff. And so now it like kind of motivates you and gives you more drive to keep kind of moving yourself forward in your career and in that regard, so that you can do the things you want, because you have all this other stuff happening in the background that again are kind of these minimums that you don't want to push into. And that keeps this whole thing flowing in the background, and you can focus on the other areas of your life.
Man, I really like that and that mindset. That's great. Hey, welcome to The Segue. On episode 77, we talked with a panel of engineers involved in open source engineering software development, including one, Connor Furster, who has a company called Structural Python.
Connor is the creator of the live course Python for Structural Engineers, and he's been delivering it to engineers around the world since 2022. It teaches you how to build your own tools for automating analysis, reporting, geometric pre-processing, and post-processing of the analysis results. In fact, you graduate the course with a powerful engineering toolkit that you have programmed yourself and which you can continue to customize.
Right, the live course is popular, but because it is live, some engineers have had a hard time judging project schedules with the course schedule. So, in April 2024, Connor is launching Python for Structural Engineers Async that allows engineers to take the course at their own pace.
I've been on the waiting list for this one since last year. I am so pumped. Connor is creating even more content for this course, but is offering it only to a limited number of participants so he can ensure all the student support that's needed is there. To apply to join the waiting list, go to structuralpython.com today and make sure to get in there early. This is going to be a cool one. I'm going to throw the link in the show notes, so it should be easy to find.
While you were talking all that, too, one thing that came to mind was student debt, right? Raising student debt in the United States is just ginormous. What would you say is your general approach? I think most students are, graduating with some sort of debt due to school. What's your general approach? Just tracking the minimums, like you're saying, or is there a value to pay that off quicker?
Yeah. So I'm going to say something that probably not a lot of people who would generally say or have heard about student debt, I guess, but at least with the current environment right now, there was all that talk about the loan forgiveness and stuff, and there's a little bit of that. I mean, personally, I wouldn't be in a super big hurry to pay off student loans right now. Now, if the president changes and stuff like that, then maybe it's a little bit different story, but there's a lot of stuff going on. And during, COVID, when the interest was paused and stuff, you didn't have to pay on your loans. Like I was saying, don't pay them, just put that money in savings. And then when they get restated, if they get reinstated, then you could just pay it all off right then, all the money you had saved, but you're going to make interest instead of paying interest. And so I look at debt from kind of, there's two sort of levels of debt, I would say. There's kind of high interest debt and then, low interest debt. And so for the most part, I think that threshold is around 7%, maybe 8%. So anything that's below that threshold, I would kind of classify as kind of lower interest debt. And that, to me, debt in general is bad, but it's not going to necessarily kill you. And so that kind of depends on how much available cash flow do you have, what else is going on, how important is it to prioritize that. If you have high interest debt, anything over that 7-8%, that should definitely be a priority. And so most student loans usually fall into kind of that lower interest category. And so, again, that's where I would say right now, I'd probably kind of maybe pay the minimum. Just because with inflation being higher, you work on increasing your income, the value of that debt is going to decrease over time because of inflation. So it's going to be easier for you to pay off over time. So a couple of years ago, I would not have answered that way.
I have a question, and it's definitely sort of in the lifestyle creep category. just going back to graduating college, you got your first job, you're making a good chunk of money. Should the first mentality be to get your own place or should you have roommates after college? What should that first step kind of look like? Got your job, new city, whatever.
Yeah. Yeah. I mean, I think it kind of goes back to the point I made a little bit ago about, okay, so you're used to living with roommates in college and stuff and eating ramen. You get your first job and you're like, man, I got all this money. And so what do? You just spend all of it instantly, right? And so the answer to this is, it's really going to be personal. Like there's a lot of factors that go into it. But again, I guess I would just kind of say, like, if you're used to living a certain way, just because like you got this job and you have, in theory, all this extra income now, doesn't necessarily mean you got to fill it up right away. And so, I think that there's kind of this level of progression that you can take of like, okay, what you kind of have to look at the whole picture, right? Do you have debt? Maybe you got a bunch of student loans. Maybe it does make sense to tackle that first, so let's take a year or two of living with roommates, keep our expenses down, and then let's tackle that debt. So then we can be debt free, and then we can focus on saving to buy a house, and you can make all that stuff happen faster. And so it really just kind of comes down to what's important to you, because to some people they kind of like that environment of being around other people and having roommates. Other people that really want their own space. So it's just always kind of this game of give and take. Like, would you rather be able to travel more? Or would you rather have your own place? And so like kind of evaluating things from that perspective.
Yeah. So to build on that, what about budgeting? Where should I start? Where should, someone right out of school start with putting a budget together?
So I don't like the word budget because I think it has like kind of a negative connotation, like everyone hates the idea of like budgeting and being told that they can't spend their money, right?
Yeah.
And so I call it cash flow, but it's basically all the same thing. And so I like to group stuff into categories or buckets, kind of like what I was explaining earlier. And I think where people struggle with budgeting is they try to say, okay, I'm going to spend $100 on groceries this week, and I'm going to spend $50 on gas every 2 weeks or whatever. And they have all these things lined out like item by item, and it's really difficult and time consuming to like track that. And it's like, oh, I ran out of money of this, but I really want to buy this thing, or I really want to go out to eat, but I'm not supposed to. And most people I don't think really are very successful with budgeting long-term over years and years. They might do it for shorter time frames. And so I prefer to group stuff up into those categories. So again, you've got fixed expenses, variable expenses. I also throw in debt as its own category, then saving, investing, and then if you have a business, maybe, expenses that are going towards that. So those are the categories I typically use. And so I think it's really helpful to break out the fixed expenses so you understand what's reoccurring, what's consistent, and you can plan around that. Then you have the variable piece, which is kind of everything else that's happening. And you just need to put a number to that. And so what I recommend people do is go back through the last 3 months or so of their bank statements, or if you want to use an app, you like Mint, they just shut that down. But there's Monarch is one that I like to use. There's a handful of others out there, but they can track those transactions for you. But figure out kind of roughly what those variable expenses kind of look like on average. And so now that's kind of your cap. And so now like you get an allowance. And so every month you basically give yourself that allowance for $1,500 or $3,000 a month. And that's what you have available to basically spend. And so whether it goes to eating out, it goes to groceries, it goes to gas, it goes to a weekend little Airbnb or something, doesn't matter. And so it makes it a lot easier for you to stick to that. And when you couple that with kind of automations and automatic account transfers, and I actually separate out these into different accounts, and then it's really easy to know if you're on track or not, because you don't have all of your money in one spot that you don't really know when the bills are coming or what you need to pay for. And so you've separated the variability from the consistency. And so that's what I generally recommend when it comes to budgeting and how to tackle, cash flow.
Man. Yeah, I really like that. It's a really good point. My wife and I use Mint, and now of course it's going away, but it's really hard to track it month to month. It's a lot of effort and time, and everything goes in there and it's in the wrong category, and you're like, I don't know what's happening, and trying to make that. So making bigger groups, I think I really like that idea. It might take.
Yeah, and the trick to that too is using different accounts for it. And so the way that I set it up for people is to you figure out all those fixed expenses, and that's its own dedicated checking account, and roughly what day they're going to happen, and usually pretty close to what the dollar amount is. So you add it all up. That's what you need in that account. And you can actually take it one step further where and I do this for my clients. And again, my spreadsheet does all this where today's the 12th. So I can open it up and look, and it says, okay, this account should have $1,500 in it on the 12th of the month. Do I have $1,500? Yes. Great. Do I not? No. Okay. Now there's a problem. And that's it. I know exactly how many dollars I should have every single day. And then in the spending account, it's it starts off at this number and it declines over time. And when it hits zero, it's I'm out. And for us, it's the 6th. So every 6th of the month, it gets refilled and we go to town again. And so it just helps keep kind of a buffer on things. And if you need more money, you can transfer money in, you can do stuff, but you have to consciously kind of make that decision. And so there's just a level of resistance or friction there that just forces you to kind of make sure that's really what you want.
Okay. I want to kind of go back to the conversation of debt and paying off debt. We talked about student loans specifically, but what is kind of a generalized way to think about debt, to pay off debt, and to kind of treat debt? I know we have a lot of different types. We talked about student loans. There's, car payments. There's your mortgage. There's all those different things. So from a general standpoint, what are the thoughts about debt?
Yeah. So kind of like I said before, I would break debt up into kind of those two main categories, kind of the lower interest debt, the higher interest debt. And higher interest debt, pretty much want to get rid of that as fast as you can. That's just going to eat you up. That's the credit card debt. Sometimes right now, maybe even vehicle loans, are getting up into that realm. If you have any other type of just kind of general loans you've taken out, usually they're going to be probably 10+% these days. So that stuff should definitely be a priority. And I think, credit cards, it blows my mind how many people, and everyone knows this, they know this, and they still do it, is just do the math, right? If your credit card is 23% interest and you carry a balance of that of, I don't know, call it $1,000, it's that's
$230.
And so, if you just simplify that and you look at it, you're not making that in the rewards, right?
Yeah.
And so it's it's just not worth it. And so I think so many people have got enamored with credit card rewards. And the thing that I see a lot is people were good. They're oh, I always pay it off. I always pay it off every month, except for then this happened and then I didn't do it. And then it's been 6 months and now I've got $10,000 of credit card debt. And it's okay, well, so you don't pay it off every month and now you can't pay it off every month. So what you should do is you should stick it in a drawer and let it sit there and just make things work without it for a couple months until you've kind of proven to yourself, that you can actually control yourself. And then once you've done that, it's okay, you can bring it back out and get your rewards again. But if you just run the numbers, there's no reason to do that. You're just basically stealing from your future self. And it just happens so quickly that people kind of get out of control with it. And once you've gotten, $5, 10, 15 plus $1,000 racked up, it's really difficult for most people to pay that off. And now you're talking 1, 2, 3 years to kind of take all their extra money just to get that balance back, which now you can't save for any goals. Everything else kind of gets impacted.
I've heard, and this is not exactly related, but I've heard the credit card company term for someone that pays off their debt every month is called a deadbeat. And I just like that a lot.
Nice.
But back to real questions. So when you get your first job offer and you're looking at this, should you be concerned about only the salary, or should the other benefits that come within that, do they have a value to analyze?
Yeah. So, I've seen this from both sides of the table because as an engineering manager, I've hired a fair number of people and stuff and looking, making offers and giving people compensation packages. And I think a lot of people, especially, younger engineers, don't always fully realize the dollar figure of benefits packages. And a lot of times, people don't always take full advantage of them. And, it's really, you got to look at the whole package as your compensation. So salary is just one component of that. And especially these days, a lot of companies have gotten very kind of generous with a lot of their benefits. And so, if there's certain things that are important to you, you can find companies, that maybe cater more to that, whether it's PTO time or 401k programs or matching, or maybe, you just want the higher salary and you don't care about the other benefits, or insurance. And so I think that those are very important things to also factor in.
So one thing we kind of talked about when we first met you was, helping make decisions where sometimes you can come in to your clients and help them make decisions on even how to kind of pick health insurance policies and stuff. Is that something common that financial advisors do, or is that something special you do? And what would you say, again, thinking engineer right out of school, how do they make that decision?
Yeah. I mean, there's a lot of different types of financial advisors out there. And so, I would say the vast majority are probably not going to help you pick your health insurance benefits, but that's certainly something that I would do, and there are definitely probably more in like the financial planning world, professionals that will help you with that. And so again, I kind of, for the health insurance is very complicated. There are a lot of things going on there. And so, I wouldn't classify myself as a health insurance expert by any means. But for the most part, from what I see, there's generally kind of two main types of plans you're looking at. There's kind of the older style kind of traditional plan, which is called sometimes. And then you have, which usually has low deductible. And then you have like the high deductible plans. And those are kind of more common these days. And so I think those are kind of the two main things you see. And so I guess talking about those specifically, and again, every plan is a little bit different and they're all going to have their own specifics. But if you have a lot of, health things going on and you expect to have a lot of expenses, then those traditional plans are pretty nice because usually maybe you have a copay and that's it, or a lot of stuff's covered. And so you don't really have to pay a whole lot out of pocket. But you're going to pay for that in your premium. So, monthly, you're going to be paying a lot more for that. And then also those plans usually only have what's called an FSA, a flexible spending account. And those things trip people up all the time because that money disappears at the end of the year. And so if you put money into it, you basically save into that account to use for health expenses. If you forget to use it by the deadline, well, then you lose it. And so it makes it really difficult because you want to save, but you don't know how much to save because you don't know how much money you need. And then you get to the end of the year and you save money and now it disappears. It's just a very weird dynamic. And so I think if you have really consistent, medical expenses, okay, that makes sense. And there are some tricks you can do to kind of work through that if you end up in that situation. But on the flip side, on the higher deductible plans, you're going to pay out of pocket. And so, you need to kind of have some money available and set aside to be able to cover some of those costs. But once you hit that threshold, then you're good. But they also have an HSA, a health savings account. And that, in my mind, is much more attractive because that continues to grow over time. And so HSA accounts are actually one of the most kind of powerful accounts out there because they're the only one that's triple tax advantaged. So it's tax-free in, tax-free growth, and tax-free out. And that's the only account like that. And you can actually invest your HSA too. And so what you can do is you can basically put money in your HSA, invest it, let it grow, never actually use it for your health expenses. And then once you're past the age threshold, you can then withdraw. If you keep track of all of your receipts and all of your health-related expenses over time, you can then withdraw once you're in retirement, basically, and use that money for whatever, as long as you have the documentation that you spent money on health-related expenses. And so there's a lot of things you can do with that are actually pretty powerful, and you don't have to worry about that money disappearing. And then, two, those HSA accounts are much easier to kind of move between different employers and stuff like that, and they stick with you, and so you can always kind of fall back to that same account.
Man, yeah, I think you just probably helped a lot of people understand just the difference of those two. I remember right out of school calling my parents I never signed up for health insurance. What would you guys suggest? And
Yeah.
Even every year when it comes back to open enrollment, I'm like, should I call my dad and ask him? Like, am I still making the right choice? I feel like the system has made healthcare just so convoluted.
It is.
It's hard.
Very complicated. Yeah. I mean, I think, I've always been pretty healthy, knock on wood, been very fortunate in that regard. And so I have very little health expenses. So like I want a high deductible because I don't want to really pay for it every month, right? Like there's no point in paying a lot of money for something I'm not going to use. And the other piece of that too is like, how good are you at saving, right? And so because I'm good at saving, I always knew that I had the money to cover the deductible. And that's another big thing too, like with the HSA account, is you should work really hard to get up to that deductible amount, relatively quickly, because then that you're basically covered for your health expenses. If anything kind of major happened in a year, you're completely covered. And so that's also a good way of kind of thinking about that too. But if you know that you have a lot of health stuff, or you're worried about stuff, or say you're looking at starting to have kids, so you're going to have more things going on, well, then maybe you do want a lower deductible plan, a more traditional plan that's going to cover a lot of that stuff.
Okay. What about 401ks? What even does 401k even mean? And then like what do companies do with it? Why do you put money towards it? Why is it beneficial? And is it the end all retirement, let's say, plan for most people?
Yeah, well, that's a great question. I don't actually know what 401k means. I'm guessing it's part of like the tax code, or it's some kind of legal section somewhere, that's usually where that stuff comes from. But basically, the government likes to incentivize people to do things because that's kind of what they do. And so that's pretty much what a 401k is a plan that is to help people and kind of incentivize them to save for retirement. And so back in the day, there used to be a lot more pensions. And so companies usually would provide a pension. You'd work there for 20 plus years, and then, they would pay you a percentage of your salary indefinitely. And so retirement was like not a big deal because you go work for a company for 40 years and then you'd make 80% of your salary until you die, like no question asked. And so it was a pretty good deal. And that's why people stayed at the same company for so long. And there's not a lot of pensions out there anymore. And so it's kind of unfortunate because it really puts things back into people's hands. Like it's up to you to make sure you're going to be able to retire. And so that's the challenging thing about it is even with these 401k plans and stuff, like there's not a lot of real education around what it takes to do this or how to use it or any of that. And so, there's two main types of 401ks. There's a traditional and a Roth. And a 401k is just a special type of investment account. You can go and open an investment account with a lot of different, companies, as you call custodians or brokerages like TD Ameritrade or Schwab, Fidelity, Robinhood is technically one. All of these companies, you can go and you can open an investment account. Well, 401k just has tax benefits associated with it. And your employer gets tax breaks. And so that's why they do it, because they actually get tax breaks. And so in a traditional account, the money goes into that account pre-tax. And so therefore you have more money going in because you didn't get taxed on it, which means it's going to grows tax-free. And then when you withdraw it, it gets taxed. A Roth is sort of the opposite, where you get taxed on the money and then you put the money into the account and then it grows tax-free and then you can withdraw it tax-free. And so both of those have their advantages. And so the main way to kind of think about it is, where do you see yourself in the tax brackets as far as your income now versus the future? Do you think you're going to make more money in the future or less money? And so if you think you're going to make more money in the future, like relative to your current income levels, and you're going to probably be in a higher tax bracket in the future, then a Roth account is going to be more beneficial because you pay taxes now at a lower rate, and then that money will never be taxed again. On the flip side, if you think your income is going to go down, a traditional account, gives you the ability to save on taxes now and actually will reduce your taxable income. So if you have a year where you make a lot more money, contributing to a traditional account might actually be beneficial as long as you're below the income thresholds where you can actually get a bit of a reduction in this year's taxes. But then you're going to get taxed on that when you withdraw it later on. So those are kind of the two main things to kind of think about there.
Yeah, I've always wondered, and the older I get, I'm so curious about why we don't educate people on money. It makes no sense to me. It's like every year I get older, I learn something new. I'm like, man, I wish I learned that in high school, right? Before I joined the real world, why didn't I learn that? So it still blows my mind to this day. All these things you're saying, it's like, man, I wish, I got out of college and someone sat me down and just said, here are the things you need to know. And from your perspective, too, of like, and I'm here to help you, right? You can hire me, bring me on board, I'll help you do these things. Cause a lot of people really don't enjoy, doing things with money. I would say most of the world doesn't like spreadsheets as much as us engineers either. So yeah, that's really, really good information.
Yeah. I mean, that was a big driving force for me to kind of go down this path, right? It was like, just kind of having these conversations with people and was like, wait, you don't know this? You don't know the differences between these things? Like, and I mean, understandably, like you said, people don't want to spend their time doing it. Okay. Like, that's fine. Like you're not going to be good at everything. And so once I kind of realized I had that expertise and the knowledge and I could help people, it was like, all right, I love talking about this stuff. I'll talk about this all day, and so I'm happy to sit down and explain these things to you. And, I really think it's unfortunate kind of the way things have developed where there is such a lack of education on this stuff, because a few good decisions early on can make a huge difference over the course of your lifetime. And that's the other piece I would say, I guess back to one of your earlier questions, what should you do kind of right out of school? Do something, right? Because like, I think where people go wrong is like, I don't have any extra money. I can't afford to save, right? Put $25 in, like put $50 in, like if you just put a little bit, it's so much easier to add more later. But if you do nothing, like I talk about going from 0 to 1, right? Like if you're at 0 to go to 1 is a lot. Like it feels like a lot. You don't know what to do. It's not in place. It's very difficult. But once you're at 1, it's really easy to go to 2 or to 3 or to 4 or to 5, right? Yeah. And so I think that's the biggest thing is like, just figure it out. Take the time early on. Put something in place, put $20 away every paycheck. And then in a year, like you'll have way more money than you would have expected. And then when you get a raise, just go back and up it from 20 to 100. And then the next year, take it to 200 and then 400. And it's like, it's just that compounding, but you just have to start and you just grow it slowly and it will happen much faster than you expect.
I like that. So when you have your first job and like just putting some numbers to this, and not the money number, but maybe percentage would be easier. Like how much of your first salary should you be investing, or, whether that's a money or a percent, I don't know what the proper answer is here.
Yeah. So I think, to some of my earlier points as well, I think it's important to kind of assess like what you have available. Right. And I think where a lot of people they struggle is like, well, I don't have the money to do that. And it's like, well, is that really true? And so I think that the most important place is to start with something. And as far as like some goals and kind of benchmarks, I think 10% is kind of a minimum, to kind of trying to be saving. That's a good threshold. If you're not there, like you should work hard to get to that 10%. If you start putting 10% away towards retirement in your early 20s, like you'll probably end up all right, compounded out over 40 years, like you'll probably be fine. And so, but you can obviously make it happen faster. That doesn't give you necessarily an awesome retirement. That just kind of means, hey, you could retire. And so I think, 10% kind of a minimum threshold. 20% is a good target. If you're doing 20%, then it's like, okay, you're probably going to be just fine. And 30% if you really want to be crushing it. And so I think that's kind of how I look at it for kind of those general kind of rates. The other piece of that too is that's looking at, kind of specifically probably towards retirement. If you want to save for other things, whether that's a house or a car or a wedding, or anything like that, kids, that also kind of falls outside that too. So it all kind of depends on exactly when you get started. But like I talked about before, kind of with that triple compounding, start really small and just add 1% every single year. Like just take your savings goal from 10% to 11, 11 to 12, 12 to 13, 13 to 14. And you do that 20 years, you'll be fine.
So what about typical investments. What should everyone be aware of? You talked about, the 401k options. We talked HSA, kind of an investment for your future and stuff. But what other options are there that are out there that are, I'm sure there's some words of how to describe investments, but where do we start?
Yeah, I mean, investments are confusing, right? Like there's so many words and phrases and options and things, and it's very overwhelming. And so I think, look, kind of going back to 401ks almost always are composed of what are called mutual funds. And so mutual funds are basically a collection of typically stocks and bonds, right? So you've got stocks, also called equities, which is basically an investment in a company. So you own a share or a portion of that company. A bond is basically like debt. So companies or governments will issue debt or basically take out a loan, and you can basically be the bank. Like that's kind of like what that is. And so they will pay you interest to use your money, and those have some kind of duration or time on them. And so the general kind of thought is, stocks are much more volatile. Bonds are usually less volatile. Stocks over time will generally lead to higher performance and more investment returns. Obviously, things are always kind of changing, but those are kind of the two main things that people look at for the most part are stocks and bonds. Mutual funds are where you have like a person or a group of people that manages like a collection of these stocks and bonds, and so they package it all into this basket, so you can buy one thing instead of all of these things. And so most people have heard, you should be diversified. Don't just own one stock, one company, and put all of your life savings into that, because there's a lot of risk potentially that could happen there. So a mutual fund kind of diversifies that risk over all this stuff. And then within that, there's thousands of these things that have like different goals and objectives, and so there's all these different types. And so in your 401k, you usually have these mutual funds. Another thing to kind of be aware of is ETFs. And so ETFs stand for exchange traded funds. And so they're very similar to mutual funds, but they're more passive, I guess. So mutual funds are generally kind of actively managed. And so you're paying fees to the people doing that work. And so mutual funds usually have much higher fees. And so they might have fees on the front end when you buy it. They might have fees as you hold it. They might have fees when you sell it. And so you can get kind of blasted with all these fees in these mutual funds. Usually in 401k plans, because of kind of the uniqueness of them, usually the fees are a little bit reduced, or they're kind of set up in such a way to not have as much fees. But if you're just buying mutual funds in general, you got to be really careful about what you're paying for. ETFs, kind of on the flip side, are similar, where it's a basket of stocks or bonds or whatever you want. And there's, again, thousands of these things. And those usually have much lower fees. And they usually don't have front end or back end fees. It's just as you're holding it. And so those are kind of the main general kind of investment vehicles people are looking at. You could also throw in money markets. Those have become kind of popular the last year as interest rates have gone up. A money market is just a specific type of mutual fund. And that's meant to just kind of reflect the current interest rates. And so it's a very safe, kind of investment from that standpoint, because it's basically, it's very similar to like a bank, paying you interest. Not quite the same thing, but those are kind of the main sort of investments that most people are usually getting involved with. And the other thing I'd say there too is, beyond just a 401k account, you can have what's called an IRA, or an individual retirement account. And that's another way. It's basically a 401k, except for you don't have to have it through work. Anyone can set up an IRA. There's also the traditional Roth options, and you can invest in that. And so that gives you a lot more flexibility, because one of the things I don't necessarily love about 401k plans is they usually only give you a handful of options. And so for most people, it's probably a good thing because they're less overwhelmed. But for someone like me, it was like, hey, I want to do more than this. Like, I want more flexibility. IRAs, you can invest in just about anything. And if you want to get, really into it, you can invest in crypto, you can invest in real estate in an IRA account if you get a self-directed. And so there's some potential, benefits of doing that. And then I also mentioned just a brokerage account, which is just like a typical kind of investment account. Doesn't have the tax benefits of like a traditional or a Roth, but again, it's another way to invest in. All of those, are going to be through some kind of provider custodian. It gives you access to all these different types of funds, the stocks, the bonds, the ETFs, the mutual funds. So
what about like what kind of alternative? You kind of said some maybe there with investing in real estate, but what other alternative investments options should people think about? Maybe not right out of school, but I'm also thinking too, like gold and silver, right? People invest and buy gold and silver. What are your thoughts on all those kind of different options?
Yeah. So I think that there's absolutely, a place for that kind of stuff. And for a lot of my clients, I recommend that. I mean, in the portfolio I hold for my clients currently, I hold a decent bit of precious metals, gold and silver. And, if you talk to a lot of like kind of traditional financial advisors, or if you read a lot of just kind of what's out there about investments, they kind of ignore a lot of that stuff. And that was one of the frustrating things for me when I was trying to do my own thing. And before I became an advisor, was like, why does no one talk about this? Like, should I have this or not? Like, it seems like it would be smart, I don't know. And so a lot of people are looking over the last, 20, maybe 40 year period when they're kind of assessing what to do. And markets change. And so I think we currently are in the midst of, or kind of just experienced a pretty big kind of regime shift where interest rates have been going down for basically 40 years. And so that just kind of flipped, and it seems likely in my mind that interest rates they'll go up and down. It's never a straight line, but going to now be more rising than they were declining. And so that's just a completely different situation than it's been for 40 years. And so I think that opens the door to a lot of different types of investments and to do things a little differently than maybe what's been done for the last while. And so I think that, precious metals, gold, silver, like if you look at their returns, they don't pay a yield, they don't get any interest for that. it's not a company. There's no expectation of growth, right? Like you're basically just hoping that more people buy it at the end of the day, right? It all kind of comes back to supply and demand. And so I think that there's periods where stuff like that is going to work well. But then there's periods where it's not. And if you look at long time horizons, gold has always done a pretty decent job of keeping up with inflation, but I'm talking like decades plus kind of time frame. But in like even in years, it doesn't always keep up with inflation. So I think it's important, like when I look at a portfolio and where should people's money go, to have a little bit of all of this stuff, because there's always an environment where, something's going to do better than something else. And it's difficult to kind of predict that or know exactly what's going to happen and when. And so I think if you're younger and you're kind of starting off, you should probably start with kind of the basics, and you should kind of build that foundation. It's like, get your cash flow in place, put some money in your 401k. You don't got to worry too much about this other stuff. If you got $20,000 to your name, it's like, it doesn't really matter if you if you make 10% or 15%, like it's not a big number. And so I think focusing on the habits and, getting that down and kind of getting the systems in place is really important. As you kind of get a little older and you kind of assets grow and you start kind of thinking about other things, then yes, I throw crypto in that bunch. I throw, real estate in there, precious metals. Those are kind of the main stuff when it comes to kind of those alternative investments. And I think absolutely, taking a few percentage or so of your portfolio and allocating to these different areas. And that's really going to come back again to kind of your goals. How much money do you have available to put to these things? What's kind of your risk tolerance? What are you willing to ride out when it comes to volatility and kind of the time horizon you have for those investments?
That makes sense. So, as you say, you're starting to look at a financial planner, what potential conflicts of interest, and also really, what should you be looking for when you make that step to look for a financial planner to help you plan your future, I guess?
Yeah. I kind of mentioned, earlier about how there's a lot of different types of financial advisors. And so it's kind of unfortunate what's happened with the industry, because there's sort of this general term that gets thrown around by a lot of different people. And so it becomes very confusing for people to understand what it is they're getting or what they're talking about. And so the two main ones now, you've got financial advisors and then financial planners. And they're sort of the same. It kind of depends. But in the traditional sense, a financial advisor was generally looking primarily at investments. And back in the day, which is still somewhat common today, a lot of those people were paid on commissions. And so they would actually call you and be like, hey, you should buy this stock. And you're like, I don't know what you're talking about. And they're like, no, it's really good. You should do it. And you're like, okay, sure. Yeah, I'll buy it. And then they make a cut from that, And so it was kind of this weird thing. And so that's kind of where a lot of financial advisors kind of got a bad rap because it's very sales based and it's commission based. And a lot of people don't even realize that that's how it works. And so, usually they're not necessarily making calls like that anymore, but they might be investing in your portfolio for you and they're making these adjustments and things. And every time they move stuff around, they get a cut. So I think it's really important to look at the incentives and understand, how are they compensated? And does that align with kind of your expectations and what you're looking for? And so beyond that, from commission-based, you've got advisors that charge asset management fees. And so they're going to take a percentage of your portfolio. Generally, it's around 1%. And so to manage your investments, they're going to charge a fee to do all the research and make the trades and handle all of that for you. And so you've got that. And then from there, you step into more kind of the financial planning realm. And some financial advisors and people that charge an asset management fee sometimes also provide these other services, but not always. So when you get into the planning realm, you're going to talk a lot more about goals. You're going to talk about taxes potentially. You're going to talk about insurance. You're going to talk about estate planning. You're going to understand kind of the whole financial picture. You're going to talk about cash flow or budgeting. And so, paying off debt. And so I think that it really comes down to kind of what are your needs. And I think especially for younger people, the challenge with working with an advisor is that a lot of them charge asset management fees. If you don't have very much money to manage, they don't make much money, which means they don't want to work with you. And so there's kind of this whole challenge where you've got people that could really use some financial help. They maybe want the help, but no one will work with them because they don't have the assets to support the time required to do it. And so that's where, when I kind of launched my firm, I wanted to be able to work with, younger people and be able to help them. And a lot of that comes around just kind of figuring things out. It's should I put money in my 401k? What kind of health insurance should I take? And answering those questions. And so when you're looking for one, it's really important to understand who do they work for? Because if you look at the company that they're tied to, who are they and how do they make their money? Because a lot of those bigger name companies, they sell products, right? They make products and they sell them, and those people ultimately sell those products. So you should be, careful of that. If you look at kind of more independent financial planners and stuff like that, most of them fall into what's called fee only. And so a fee only advisor is someone that only gets paid based off what you pay them. They don't make commissions or have anything going on in the back end that they get compensated for. So it's much more transparent. And so that's a great place to start. And then the other kind of big term there is fiduciary. And so this is confusing for people because it seems so obvious that why does this even have to be a thing? But it kind of goes back to the history of the industry. So a fiduciary is someone that has a legal obligation to work in your best interest. And for most people, you'd be like, well, why would I want someone to not work in my best interest? Right? But for some advisors, they're only held to what's called the suitability standard. And so they only have to do things that are suitable for you, not necessarily what's in your best interest. And so, again, if I would recommend, you look for someone that's a fee-only fiduciary that's going to work in your best interest, that's paid in a transparent way that you can understand and when you're actually paying them. And it's going to provide the type of services that are important to you and that you need. And so understanding, I guess, kind of that people can do a lot more than just manage your investments. And for most younger people, those are the things they really need help with. You probably need someone that's going to charge you in kind of an hourly way or some kind of project based where it's going to be X amount to tackle this particular problem or, work through your situation. And that's something that, you can actually do and everybody kind of wins in that situation.
Yeah. So with all this amazing information, what would you like to say, kind of our last question here, what would you like, all young engineers that are listening to this to know about their finances?
Yeah, I think, the most important thing is just get started, right? Like kind of back to the 0 to 1 piece is just get a system in place, spend a little bit of time, kind of figure these things out, group your money into these categories and figure out kind of where it's going. And then just create some benchmarks, create some separation between your money with these different accounts and figure out, what is a reasonable amount to kind of put in these different areas. Set up some automatic transfers, kind of get the ball rolling and just let that do its thing. And then, when you get a raise or you move jobs or something happens, you can kind of reassess. And I think the biggest thing that I see with people is just being reluctant to start because they don't think that they can. And so it's like you will thank yourself 10 times over the earlier you start. And so if you just put in $20, put in $100, whatever you can do, just get it started and then try and level up from there. Right. And so, if you put in some conscious effort and every time you get a raise or a bump in pay or compensation, at a minimum, take 50% of that and put that into more saving, more investing, and take the other 50% and use that to expand your lifestyle. And you can even do more than that if you want. But at a minimum, just do that. And just don't always, every time you move your income up, just don't spend it all. And I think you do these little things and you just consistently level up, 10, 20, 30 years, like you're going to be doing just fine.
Man, that's awesome. Well, Ryan, thank you so much for being on our podcast today. I think Max and I both learned a lot of information from you about finances. And I know our listeners will too, because we get these questions all the time. So thank you so much.
Yeah, it was great talking with you guys. And I love sharing this information. And so always happy to answer people's questions and help how I can.
Yeah, and if anyone has any questions for Ryan, we've got all of his information down in the show notes. Thank you, Ryan, and all of you for joining us on this week's episode of the Structural Engineering Podcast. If you have any questions, please feel free to reach out on LinkedIn, Instagram, or email. We will also have Ryan's contact information down in the show notes. And as always, have a great week. Disclaimer, none of this is meant to be financial, tax, legal, or investment advice. Information is provided for general education purposes only. Do your own research and consult with a licensed professional prior to making any major decisions.